We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. Inflation finally cracked in the US, with CPI sliding to multi-year lows. But that relief was immediately offset by a jump in unemployment and weakening growth signals under the surface. Europe splintered as the Bank of England shocked markets with a surprise rate cut, while the ECB stayed cautious and Nordic banks held the line. In Asia, the Bank of Japan delivered a historic rate hike, its first real exit from ultra-easy policy. Yet the yen weakened as markets questioned its resolve, while China's consumer and investment data confirmed a deepening structural slowdown, with no bold stimulus in sight. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
This week, the global markets have given us just a masterclass in tension. As we're all hurtling toward the holidays, the story is just completely split. On one hand, we have these definitive signs of fading inflation, which gives everyone hope.
Right.
But on the other, this is constantly being undermined by, well, profoundly uneven and often fragile global growth.
Yeah, it wasn't just another week. It was a week that delivered these long-anticipated tectonic shifts in monetary policy.
Tectonic is the right word.
We saw the Bank of Japan, the BOJ, finally make a historic exit from its ultra-easy policy. Here in the U.S., we got a welcome and, frankly, shocking cool-down in our key consumer price gauge.
And then the Bank of England, the BOE.
Right, which executed this abrupt and powerful dovish pivot that surprised nearly everyone.
That is a ton of change for the final full week of the year. I mean, policy everywhere is moving, but it is not moving in unison.
Not at all.
We need to isolate those critical movements and understand what they mean for your portfolio, not just now, but as we head into 2026. Okay, let's unpack this. Our mission today is to distill the true meaning behind all the noise and set you up with the clearest view of the global monetary landscape.
Let's do it.
So let's start in the Americas, specifically the U.S., where the indices told a very complex story this week. The S&P 500, it managed a small gain, and the tech-heavy NASDAQ finished up 0.48%. But if you look under the hood, the rest of the market was, well, it was yelling caution. Small and mid-caps, tracked by the Russell 2000, lagged significantly. They finished the week down 0.86%. So why the divergence?
It's the definition of selectivity. I mean, the gains were all driven by these high-quality, growth-oriented tech names.
Okay.
It reflects investor confidence in their ability to deliver earnings even in a slower economy.
Yeah.
But the small-cap names, the ones far more exposed to domestic growth and debt costs, they're struggling. That market split is a clear warning sign that risk appetite is highly concentrated.
And that caution just flies directly in the face of the single biggest piece of good news this week.
The inflation surprise.
The inflation surprise. We saw the headline gauge of consumer prices, the CPI, rise just 2.7% year over year in November. That was substantially below estimates.
And critically, core inflation, which strips out volatile food and energy costs, that dropped even further to 2.6%. That is the slowest pace we've tracked since, March 2021?
Wow.
For the Federal Reserve, that number is a massive sigh of relief.
And the component that's been the most frustrating, shelter inflation, it finally eased to 3.0%.
Yeah.
Is this it? Is this the proof we needed that the disinflationary trend is now firmly established?
It certainly makes the case. I mean, when the stickiest parts of the index finally start moving, it suggests the overall trend has momentum. But the good news kind of ends there.
Okay.
Because the labor market painted a much, much gloomier picture, introducing that tension you mentioned right at the top.
Right. The November jobs report was a mixed bag that leaned heavily toward weakness. Payrolls grew by 64,000, which, technically beat expectations.
Technically.
But that headline figure was completely overshadowed by the crucial detail that the unemployment rate jumped to 4.6%. That's the highest level we've seen since early 2021.
And a jump like that in the unemployment rate suggests a sudden weakening of underlying demand for labor. And if you couple that with the business activity readings, the S&P Global Flash PMI fell to a 6-month low of 53.0. You see companies reporting weaker hiring plans alongside renewed pricing pressures.
So margin squeeze?
Exactly. Margin squeeze and hesitancy to commit capital.
So if the inflation number is the clearest green light the Fed has had in years, is the unemployment jump the equally clear red flag, the one that signals they might be going too far? What's the thinking now on the soft landing?
What's fascinating here is a trade-off. Cooling inflation gives the Fed immense room to maneuver, to pause their tightening cycle. But that jump to 4.6% in unemployment, it raises an important, even provocative question.
Which is
this jump the necessary evil required to get inflation permanently below 3%? Or is this the first undeniable crack in the economy that proves we are headed for a hard landing?
It's the Goldilocks problem, isn't it?
Yeah.
The Fed needs things to cool down but not freeze solid.
Right.
And right now, the labor market is starting to look awfully frosty, which means we are far from assured of that gentle glide path everyone has been wishing for.
Precisely. The market is now pricing in cuts much sooner, but that's because the market is reacting to the weakness, not anticipating some robust new growth.
Okay, moving from the U.S. where caution prevails, let's pivot across the Atlantic to Europe. Markets there embraced a policy shift with a lot of enthusiasm. The SDOXX 600 finished the week up a robust 1.60% entirely on central bank hopes.
That optimism came despite the European Central Bank, the ECB, maintaining its consistent, cautious stance. They held rates steady for the 4th consecutive meeting.
Right, Lagarde is still very data-dependent.
Very. And their latest projection that inflation won't fully stabilize near their target until 2028 tells you they are in no rush to declare victory.
But the Bank of England, the BOE, completely broke ranks with that patience.
It really did.
They surprised everyone by cutting rates by 25 basis points, dropping their benchmark to 3.75%. That was a huge statement of intent.
It signaled that the UK is in a different boat entirely. Their justification was pretty straightforward. Inflation has dropped significantly to 3.2%, and their unemployment rate has climbed to an uncomfortable 5.1%.
So they had to act.
They felt compelled to act. But here's the truly intriguing detail you mentioned.
The 5-4 split.
The 5-4 split decision. It wasn't unanimous.
A 5-4 split suggests fierce internal disagreement. What data point were those 4 dissenters looking at that made them so cautious about cutting right now?
Well, those 4 were likely focused on wage growth. Despite the rise in unemployment, wage pressures are still sticky in the UK. They're worried that cutting too early, before inflation is truly crushed, risks having to hike again next year. That 5-4 vote really highlights the tension between the growth concerns of the majority and the inflation-fighting concerns of that strong minority.
Meanwhile, Britain's Nordic neighbors were not following suit.
No. Sweden's Riksbank and Norway's Norges Bank both held their rates steady, citing the need for restrictive policy amid lingering inflation risks.
So it's messy.
This is the crux of the European situation right now. Divergence. You have the UK easing aggressively while neighbors like Sweden and Norway pause. Divergent labor markets and fragile growth paths across the continent make any kind of coordinated recovery path extremely complicated. For you, the listener, this means the headline European numbers are almost useless. You have to focus on country-specific central bank signals.
Okay, so if the UK's policy coordination seems complicated, it looks tiny compared to the shifts happening in the East. Asia delivered the week's extremes, a historic rate hike in Japan, and then this deeply concerning structural weakness in China. Let's start with Japan, where Nikkei actually fell 2.61% after the historic move by the Bank of Japan.
The BOJ finally delivered the long-awaited signal that Japan is moving away from its decades-long era of ultra-easy monetary policy. They lifted their benchmark rate to 0.75%.
Which is huge.
To emphasize the magnitude of this shift, that is the highest level it has been since 1995.
1995.
Think about that. 1995 was before the widespread use of the commercial internet. That's how far back this policy pivot takes us. The move was driven by core CPI holding firmly at 3.0% year over year.
So we have this historic move signaling the end of deflation, and yet the yen weakened to 157.3 per dollar. That seems like a complete paradox. Why did a rate hike which should strengthen a currency actually weaken it?
This raises the critical question of policy credibility. The market reaction reflected profound skepticism regarding the pace of future tightening. Borje Governor Ueda is clearly employing a very cautious or go slow strategy. He's worried about prematurely snuffing out Japan's fragile economic recovery.
So the market called their bluff.
Essentially, yes. The market saw the hike, nodded, and then said, if you're going to drag your feet for the next 2 years, the yen isn't worth buying. That lack of clarity on the future trajectory is what spooked investors and weakened the currency.
On a positive note for Japan, though, those weak yen levels continued to be a massive boon for exporters. Exports rose 6.1% year over year, right? Boosted by U.S. demand.
It's true. But the weak yen remains a double-edged sword. It drives massive profits for companies like Toyota and Sony, but it simultaneously weakens the purchasing power of the average Japanese consumer, which slows down the domestic recovery.
Okay, now, swinging over to China, where the recovery narrative just continues to struggle. The CSI 300 was down slightly, and we saw some truly alarming data points emerge this week, particularly around the consumer.
The consumer is the core problem. Retail sales posted just a 1.3% year-over-year gain in November.
1.3.
That is the weakest growth rate they've recorded since the peak of the pandemic-era lockdowns. It tells you domestic household confidence is utterly fragile. They are refusing to spend.
And the investment picture seems structurally broken. Fixed asset investment showed a shocking 2.6% drop in the year-to-date tally. If that holds, it will be the first likely annual contraction for that measure since 1998. That isn't just a cyclical downturn. That is a major structural shift.
It signals a fundamental structural unwinding of China's old debt-driven growth model. For decades, China relied on massive investment in infrastructure, property, factories to drive GDP. A contraction in FAI suggests Beijing is finally pulling back from that model, but they're doing so without robust domestic consumer spending ready to take its place.
And industrial output, the factory production measure, also missed expectations, rose only 4.8%. The key takeaway from the recent Central Economic Work Conference was that while they pledged flexible policy tools, Beijing steered entirely clear of any bold, sweeping stimulus.
Exactly, nothing for the consumer. So China's growth remains overwhelmingly reliant on exports to keep the lights on. Without a decisive, bold dose of stimulus aimed directly at lifting domestic household confidence like direct cash payments, the path to a robust, self-sustaining recovery remains frustratingly elusive.
All right, let's pivot now to the week ahead. Most of the world's markets will be slowing down for the holiday, meaning low liquidity, but the U.S. has a crucial data dump right before Christmas that we cannot ignore.
Right.
On Tuesday, December 23rd, the U.S. has 3 major scheduled releases. First, the initial estimate for Q3 GDP.
Which will be heavily scrutinized.
Heavily. Any sign that economic momentum is evaporating will be jumped on. Second, we get durable goods orders, which gives us a look at capital investment. And third, the Consumer Confidence Index. These 3 together will really define the U.S. picture going into the new year.
And then on Wednesday the 24th, we get the final piece of key employment data for the year, weekly jobless claims. Given that big jump in the unemployment rate we just saw, any unexpected increase here will spark immediate concern about the pace of the labor market slowdown.
The holiday caveat, of course, is that U.S. markets are closed Thursday, December 25th, and there are no major releases scheduled for Europe, the UK, Japan, or China. It promises to be a quiet end to the year for most international traders.
If we connect this to the bigger picture, quiet trading absolutely does not mean low risk. In fact, now is the time to be extra vigilant, specifically because of that low liquidity.
Before we get to our risks, can you quickly define that for our listener? Why does low liquidity suddenly amplify market risk?
Sure. Think of liquidity as the number of available buyers and sellers. In the middle of the day in January, you have millions of participants. If bad news hits, a large number of buyers and sellers are there to absorb the impact, so price moves are orderly.
Got it.
During the holiday lull, that participation just drops off a cliff. So if a major fund needs to sell, say, $500 million of stock, there are simply fewer people available to buy it.
Okay.
This means that a relatively small trade or a minor piece of news can cause a completely disproportionate, rapid, and volatile price swing. There's just no resistance. That's why we need to be extra cautious.
That makes this next section even more critical. Let's run through our top 5 risks to watch for the holiday period. What should you, the listener, be keeping an eye on while liquidity is so thin?
Okay, risk number 1 is the U.S. growth surprise, or the lack thereof. That delayed Q3 GDP print could fundamentally reset expectations for 2026. If that number is soft, recession fears will resurface immediately, overwhelming any of the good news we had about inflation.
Risk number 2. Sticky core inflation in developed markets. We got great CPI data this week, but persistent price pressures could still slow the easing cycle, especially in Europe where, the UK just cut, but Sweden is holding steady.
Right.
We need to watch for the risk of a surprise upside in January's CPI or wage data that could instantly reignite rate hike talk, a possibility the market is currently dismissing entirely.
Risk number 3 centers on China's consumer slump deepens. The weak retail data, it really underscores the failure of Beijing's current incremental policy strategy. Continued softness risks dragging down global commodities and emerging market assets, which rely so heavily on robust Chinese demand.
And risk number 4 is BOJ policy credibility tested. The market is highly skeptical about Japan's tightening resolve. If the yen remains perpetually weak post-hike, it may force the Bank of Japan to take further, potentially destabilizing action just to restore faith in their policy.
And that could introduce instability back into the Japanese bond market.
Finally, risk number 5.
And finally, risk number 5, and the most amplified due to the holiday lull. Geopolitical surprise in a low liquidity week. Any external, non-fundamental geopolitical headline escalating Red Sea shipping threats, new Taiwan tensions, or an unexpected oil supply shock could cause absolutely outsized and disproportionately volatile market moves because there's simply no one around to trade against the shock.
That is the crucial context you need going into this quiet period. To synthesize the week for you, cooler inflation in the U.S. gave a much-needed shot of hope to the soft landing narrative, suggesting the worst of price pressures is behind us. But the global narrative remains profoundly fragmented and complicated. Japan is finally hiking, China is struggling with a consumer slump and a structural investment pullback, and Europe is moving toward easing, but at different speeds.
This knowledge provides you with the necessary roadmap for what promises to be a very quiet trading week ahead, at least based on economic fundamentals.
But remember that final risk. Although the fundamentals will be quiet, the low liquidity environment means that an external, non-fundamental geopolitical event could cause disproportionately violent moves. If a crisis hits when the market is asleep, the volatility is amplified exponentially. So, do not let your guard down during this holiday lull.
We'll be watching. Happy holidays, and we'll see you the new year to unpack whatever the market throws at us next.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold. Built by Flamingo's Research and Advisory.